Okay, good. So tonight we'll be looking at IAS 23 borrowing cost. And what is borrowing cost all about? Borrowing cost has to do with how we account for the finance cost we incur on borrowed funds for the purpose of the business. Now, ideally, when we talk of borrowing cost, which is also our finance costs are expensed in the statement of profit or loss as at the period it relates to. That is, when we incur it this period, we expense it. The one we incur next period, we expense it. And when we use the word incur in accounting, it simply means expenses for which we have enjoyed its benefits. Right? Either we have paid for it or not. So far it has been incurred, we have to account for it. Yeah, that's that. So now, what is now IAS 23 on borrowing cost telling us? IAS 23 on borrowing cost is telling us that it's talking about those borrowing costs that are in connection with the acquisition of an asset, that are in connection with the or what's it called? Acquisition or construction of 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 an asset. Now, the core principle of IAS 23 is that any borrowing cost that is directly attributable to acquisition, construction, or production of a qualifying asset should be capitalized as part of the cost of the asset. What does that mean? The borrowing cost we incur that we can directly attribute to either acquisition or construction or production of a qualifying asset. That is very key there. Qualifying. Qualifying asset. It should be what? It should be capitalized as part of the cost of the asset. And when we say something should be capitalized, it means it should be taken as part of the what? As part of the asset cost. It means it should be taken as part of the asset cost. So what that means is that instead of us to expense the borrowing cost that relates to the acquisition or construction or production of an asset, of a qualifying asset, IS 23 is telling us to capitalize it. Now, IS 23 defined borrowing cost to be interest and other costs that an entity incurs in connection with borrowing of funds. What do we mean by that? Borrowing cost is not necessarily the interest alone, but there might be other costs we incur. There might be other costs we incur that has to do with what? With borrowing for the purpose of the what? With borrowing of funds. Take for instance now, if you take a loan from a bank, aside the interest you'll be paying on the loan, when you are taking the loan, they will tell you you will pay management fee, you will pay processing fee, you will pay legal fee, you will pay this, you will pay that. All of those things too, they are part of your what? Borrowing cost, because they are in connection with borrowing of funds. They are in connection with borrowing of funds. So, and borrowing cost includes the finance charges in respect of finance leases. Also, we have financial assets and inventory that are manufactured or otherwise produced over a short period of time are not qualifying assets. I'm still coming definition of qualifying assets. I'm still coming to definition of qualifying assets. But what that is saying is that um sorry. So what that is telling us is that before we can call an asset a qualifying asset, it must be an asset that would necessarily take a substantial period of time to get ready for its intended use or sale. It must be an asset that will take that will necessarily take a substantial period of time. Now, the standard was silent as to what a substantial period of time is. So determining what substantial period of time will be is a function of an entity's accounting policy. Your accounting policy might be an asset that will take an asset that takes 3 months and above to produce is what you are taking to be a borrowing cost. Another entity can say 6 months and above. Another one can say 1 year and above. Another one can say it is only if it takes 1 month and above. It is a function of the business accounting policy. But what is most important to us is that if the asset will take a substantial period of time to get ready for its intended use or sale, then we refer to it as what? As qualifying asset. However, the standard now say if it is a financial asset or inventory and the manufacturing will take only a short period of time, it doesn't qualify. It doesn't qualify as what? It doesn't qualify as it doesn't meet the criteria to be called a qualifying asset. It doesn't mean so. Example of qualifying asset can also be inventory. That is, if it will take substantial period of time, not a short period. Now, manufacturing plants and power generation, amongst others. Now, for borrowing cost to be eligible for capitalization, it must be the borrowing cost on that borrowed funds during the period of capitalization. During the period of what? Capitalization. What do we mean by that? You don't just say, okay, you borrowed funds, so you capitalize the. Even if the asset is a qualifying asset, there is what we call a period of capitalization. And what is that period of capitalization? It is the period from which the asset, from the date we come, the earlier, once the asset construction commences and the borrowed funds start counting, to when the asset is available for use. So when the asset is what? So when the asset is available for use. So what are we saying? Now, to calculate borrowing costs, we have two types of borrowing. We have basically two types of borrowing. We have what we call special or specific borrowing. Specific borrowing. Yes, we have specific borrowing. And we also have general borrowing. When we say specific borrowing, I want to take this class. And I know to take this class, I will need a writing device. And I ask, how much is the writing device? They say 500,000. I approach a finance house and say, I want to take a loan of 500,000 for the purpose of buying this thing. They gave me the money and I use it to buy the writing material. That is a specific borrowing. But general borrowing is where I have 2, 3, 4 loans and I need to buy this writing material. I just took the money from those 3, 4 loans and used it to buy the assets. Now, don't get me wrong. I'm not saying where we have a specific borrowing, it is only that borrowing we will use to finance the asset. Specific borrowing might only be financing part of the asset cost. But in most cases, specific borrowing is just one borrowing. It is just one borrowing that we are using to finance the asset. The moment the borrowing we are using to finance the asset is more than one, it is referred to as what? General borrowing. But another thing that will make it to be a general borrowing is that the entire proceeds of that loan is not used for the asset alone. The entire proceeds of that loan is not used for the asset alone. What do I mean? If I have three borrowings now, borrowing A, B, C, but the summation of the three borrowings is what I'm using to finance an asset. If all of it is just to finance one asset, it may be the the way we will treat that kind of borrowing, we will treat it more like a specific borrowing, because the whole is used for only that asset. But for general borrowing, deposit from the loan is not only used for that asset, it will be used for other purpose. And in most cases, because it is not one loan, the interest, yes, the interest rate will differ. So for us to determine what amount of the interest will be attributable to that asset might be a bit difficult. And that is why when we have specific borrowing, to calculate the borrowing cost, it is just the interest rate. It is basically the interest rate multiplied by the borrowed funds, or the portion of the borrowed funds utilized for the asset. But when it comes to general borrowing, we have to first calculate what we call weighted average capitalization rate. Weighted average capitalization rate. What is weighted average capitalization rate? So weighted average capitalization rate, WACR, is just an average of the interest rate, or of the interest element on the general borrowing. We used part of it to finance the asset. Are we getting it? And we calculate that as total interest divided by total borrowing. Please, are you guys with me? Hello?
Yes, we are with you, sir.
That's for weighted average capitalization rate. Now, another thing is, this weighted average capitalization rate, we'll now use it to multiply the borrowed funds that was utilized for the assets. We use it to multiply the borrowed funds that was utilized for the asset during the period of construction. During the period of construction. That's for general borrowings. It is only from the date the funds was utilized for the assets that will start capitalizing. We don't capitalize before the funds were used for the asset. We don't capitalize after the asset is available for use. But in the case of specific borrowing, even if the asset was used, even if the borrowed funds was used at a later date after construction has commenced, we'll still capitalize for the entire period. We'll still capitalize for the entire construction period. We'll still capitalize for the entire construction period. That's that. But another thing is, now the portion of the interest expense, borrowing cost, that is not being capitalized will not be discarded. It will be what? It will be expensed in the statement of profit or loss. It will be expensed in the statement of profit or loss. Before we can start capitalization of borrowing cost, the following things must be met. One, we must have started incurring expenditure on the asset. Not that you borrow, if you borrow funds in January, you start the asset construction in April, the interest element of January to March will not be capitalized. It will be expense because you've not started incurring expenditure on the assets. That's one. Another one is that the borrowing cost must have been incurred. We must have started incurring the borrowing cost. What do I mean? You've taken a loan, maybe a 5-year loan from bank to construct a building, but the bank is giving you a moratorium period. Do we know what moratorium period is?
No, sir.
Hello? Okay. Moratorium period is the grace period you have to utilize the loan before you start repayment. You know, it is not okay for you to take a loan today now and they say start paying back tomorrow. If you don't use the money you borrow to generate money, how will you get money to start repaying? And that is why in some cases, especially for those that are used to, those that borrow all this LAPO money and the likes, that is why in most cases they have difficulty in repaying. They will borrow money this month. By next month, they are expected to start repaying. I don't really know how their package works, but I think that's what happens most of the time. You borrow money this month, maybe they say you have to repay over 12 months period. You start paying the next month. Between this month and that next month, you have not even making any benefit of the, you've not even gotten any benefit from the money you borrowed. So moratorium can be like, okay, we'll give you 3 months to first utilize the money. Then from the 4th month, you start paying. The money will start, interest will start counting on the money, and you have to start paying the interest or both the interest and the principal. Now, where that is the case, let's assume you've taken the loan in January, and even if you have started construction in January, but you have a 6-month moratorium period, meaning your interest will start counting from July. You will only start capitalizing borrowing costs from that same July. You can't start capitalizing for January. The next one is that activities are in progress that is necessary to prepare the assets for its intended use. Incurring expenditure is not the only thing. There must have been activities. If you want to build a house now, have you started taking the planning permission, the building permission? Have you engaged the services of an architect? Have you guys drawn out a plan on how you build and all of that? If there are activities in place, you have started incurring borrowing costs and you started making expenditure on the building, that is utilizing the borrowed funds for the building, then we can start capitalization of borrowing costs. Now, when will capitalization of borrowing costs cease? It ceases when all necessary activity to prepare the assets for its intended use has been complete. It ceases, capitalization of borrowing costs ceases when all necessary activities to prepare the assets for its intended use has been met. And also we have suspension of capitalization. When do we suspend capitalization of borrowing costs? Capitalization of borrowing costs will be suspended if the work on the asset is also being suspended, where there is temporary delay in the work of the asset, the payment of borrowing costs, the capitalization of borrowing costs will also be what? Will also be suspended. What do I mean? Take for instance now, you are building house. Then maybe after doing for 1 month or 2 months, you feel like you don't have the capacity, or maybe you don't have the energy to continue. You say, let's take a rest. Let's take 1 month rest. Whatever interest cost that 1 month has will not be what? It will not be included in what we have to capitalize. It will not be included in what we have to capitalize. That's what we call suspension of borrowing cost. However, if the suspension is part of what is necessary for the asset to be in the condition you want it to be, then we will not suspend capitalization of borrowing cost. What do I mean? You know, I don't know. We are familiar with building houses, are we? Are we familiar with building houses?
Yes, sir.
I understand we are not, some of us are not landlord yet. Don't worry, me too, I don't have house yet. But I pray we all get to build one. But now, when we are building, when they build the house to a certain level, especially when they get to lintel level and they do the starting out, there's this casting they are to do. There's this casting they are to do for the lintel. I mean for the what is it called? There's this casting they are supposed to do for the window side, the door, and the lights. That thing, if you do it, you cannot just continue work immediately. You have to give it some time to get dry before you proceed. Also, when you are building story houses, let's say 2-story building, 3-story building, when you do the decking, you cannot just do decking today. Tomorrow you start building on it again. If you are not careful, the house will everything will just end up in futile effort. So when you do the decking, you have to give it time. You have to give it time for the decking to actually get dry before you proceed and put another one on it. Before you proceed and put another one on it. So all of those periods, even if they are material period, we don't suspend capitalization of borrowing costs because the action is necessary to get the asset ready for its intended use. That's that on that. That's that on that. Yeah. Aside that, what else do we have? We also have that. We also have that. Yeah. We also have what we call we also have what we call investment income. Investment income. How do we have investment income? Now, let's take for instance, you've taken a loan, and after taking the loan, the bank or the financiers has credited you with the full amount of the loan, but you are not utilizing everything at once. You are not utilizing everything at once. As a good finance student, you will not leave the fund idle. You will not leave it idle. Now, if you invest such fund and you get any interest income on it, the interest income will be used to reduce the borrowing cost to be capitalized on the asset. What do I mean? We have we are we are taking we've taken 100 million loan for the construction of our head office. Now, we already understand that we are not utilizing the whole 100 million at once. We've bought these blocks, the sand, everything. But money for interior decoration, money for maybe finishing work and all of that we know we are not spending now, is still remaining with us. Instead of us to leave that one useless there lying around, we can invest it. We can invest it. So if we invest it, whatever income we make on the investment is what we call investment income. The investment income will use it to reduce, so far it is during the period of capitalization, we'll use it to reduce the asset cost. We'll use it to reduce or repay part of the asset cost. That is for investment income. Now, this one that I just said is basically for investment income. That's basically for investment income. But also we can have what is it called? That is basically for, so we can also have other investment income. Can also have maybe investment income before the asset or before the assets come into existence. Now that one will be what? Taken to SOPL. Now, Another thing is, if the loan is a general loan and we have investment income, we don't use investment income on general loan to reduce the asset. Rather, we just what? Rather, we just take it to our SOPL. We just take it to our SOPL. So another thing is when we have bank overdraft. When we have bank overdraft, do we all know what we call bank overdraft? Hello? Hello? Can you
Hi,
guys hear
sir.
me?
Yes, sir.
Do we know what we call bank overdraft?
Yes, sir.
Uh-huh. Now, because bank overdraft is not as if um the bank will not give you a specific or a certain amount and say, okay, this is 100,000, but they would have increased your balance to that tune that okay, you can spend more than what you have in your account up to this amount, and that money is always fluctuating. As you are having, if anybody send money to you in your account, it will reduce your overdraft balance. It will just be moving like that. So now, for the purpose of borrowing costs, when we have general borrowings, and bank overdraft is one of it, they would give us weighted average interest. They will give us weighted average interest. So they will give us the average, the interest for the period, the total interest for the period, and they will give us the weighted average of the loan. They will give us the weighted average of the overdraft facility, and that's what we'll use when we are calculating our weighted average capitalization. The total interest on the bank overdraft will be here, and the weighted average of the overdraft for the period also will be there. And that's all we have on capital on IAS 23. The next thing is just closure requirement. And the closure requirement will be what's the amount of the borrowing cost capitalized during the accounting period, or what capitalization rate did we use in calculating the amount of general borrowing costs that are eligible for capitalization, amongst other things. Any question for me? Any question for me?
I
None.
sincerely apologize for the inconvenience. I sincerely apologize for the inconvenience. I might need you to assist me in going back to that investment income analysis very well, please, because I'm a little bit confused and I don't want to draw you back. That's why, pardon me.
Albert, thank you very much for not disappointing me. If you had not asked question, I would have believed something is wrong in this class. But thank you. Investment income. Like I said, investment income is an income that is made from the excess of the borrowing funds. What do I mean? I want to build a house. I've approached the financier and took the loan of 100 million. You will agree with me that I will not use the entire 100 million on the day I'm starting construction. Even if I have bought some things, the money will be remaining. Now, the remaining portion of the money, instead of me to keep it useless for the period of the construction, I can invest it. If I invest it, any gain I make from it will now be what? Will be used to reduce the borrowing cost. You know, you are making that gain from utilization of the borrowing funds. So you will be using that income to reduce the borrowing cost that we have to capitalize. And I said, if the investment income was made before the asset, then just take that one to SOPL as an income. Is it clear now? Is it clear?
Thank you.
Okay.
Thank you.
So that is that. Any other question before I dive into solving question?
Hello, good evening, sir.
I'm with you.
Sorry, sir. Please, can you please explain the meaning of bank overdraft for us?
A bank overdraft is just excess payment. Yes. It's a facility granted by bank to a current account holder, enabling them to withdraw more than they have in the account. Like now, if you have a current account, you can apply to the bank to get an overdraft facility. So what the overdraft facility does is that it enables you to withdraw more than you have in the bank. Even if you don't have money, if you have the overdraft facility, you can still be making payments from the account without having money there. It is your overdraft you will be using. So that will make your bank balance to be in negative balance, and they will now be charging you interest on it. Is it clear? Is it clear?
Yes, sir. Yes, sir. Thank you.
Okay, it seems the ladies are on their high speed this night. They don't have questions. So let's look at few illustrations before we call it a time on this call. Let's start with question 2. Who is reading? Question 2, who is reading? Or should I read it myself? On 1 January 2011, Aminat PLC borrowed 35 million to finance the production of assets, both of which were expected to take 1 year to build, but will be available for use after 3 months of completion. Production started during 2011. The loan facility was drawn down on 1st January 2011 and was utilized as follows, with the remaining funds invested. The loan interest rate was 15%, and the company can invest surplus fund at 7%. What are the borrowing costs to be capitalized for each of the assets? Determine the cost of the assets as at 31 December 2011. Are we there?
Yes, sir.
Calculation of borrowing costs to be capitalized. So we'll have what? It will just be borrowing cost will just be, because this is a specific loan. The entire 35 million was taken to finance this asset. And we have said where we have a specific loan, we'll just capitalize the whole interest rate incurred during the period of construction. So it will just be, they've given us the interest rate to be 15% of how much they borrowed 35 million. Because if you look at how they utilize the funds for the business, for the project, it was the whole 35 million. Multiply by what? Multiply by 1. Because the transaction started on 1st January 2011. And we are still in 2011, so it means it will have just been 1 year. It should have just been 1 year. So that will give us what? What will that give us?
5,250,000.
5,250,000.
Excuse me, pardon me. The formula you gave earlier was interest rates times borrowing cost. With what you are stating on the board, does it mean that we have to add in the number of years included?
Yes, now you already know when I say interest rate times borrowed funds, you have to prorate if the number of months is not up to 1 year now. And if it is more than 1 year, you have to calculate for the remaining period. Is it clear?
Yes, thanks.
Okay, that's the borrowed funds. That's the borrowed funds. However, this is the borrowing cost. Sorry, this is the borrowing cost. But they've told us that surplus funds can be reinvested at 7%. And they told us the remaining funds were invested temporarily. So I'll now say less investment income. Investment income. What is the investment income? We'll have 10 million multiplied by the 7%. Multiply by how long can they invest the 10 million for? They can invest it between January to August, because that money wasn't needed as at January, but the money is with them. So they can invest it from January to August. That will be 8/12. The second one they will invest is the 5 million they used in December. The 5 million times 7% multiplied by what? Multiply by that one will be invested for 11 months. 11 months. And that will give us what, please? Figure. Hello?
That's 46,000.
0.467. 6,700.
0.467. Hello? Hello? Oh yeah, I can't be begging for figure physically and still be begging for
0.32.
me go
0.321. 0.321.
0.321. 0.321. So if we now take out these two from this figure, what will be the borrowing cost to be capitalized?
Zero point one four six.
0. No, that should be 4.462. You know, you are considering this one up here, the borrowing cost. So this gives us the borrowing cost to be
Okay.
capitalized. Then that takes us to the next question, which is cost of the asset.
Sorry, why are we
Huh?
getting zero? Why are we getting 0 points? Are we multiplying everything by 100? Because I'm getting 46.67.
No, it can't be 46 now. You know, we are quoting all the figures in millions. So you just do 10 multiplied by 7%. That's
Okay.
0.07
All
multiplied
right.
by 8 divided by 12. Is it clear?
Yes, sir.
So to calculate the cost of assets, we'll say construction cost. Construction cost. What are the construction costs? As at 1st January 2011, we have, sorry, calculation of cost of assets. So we'll have construction cost. First January 2011, 20 million. 1st September 2011, 10 million. Then 1 December 2011, 5 million. Then borrowing cost capitalized 4.462 million. So that will give us a total of how much in total? 39,462,000,000. Is it clear?
Yes.
So that
No.
about the that is that about that. Do we understand?
Yes,
Let's look
sir.
at question 3. On 1st January 20X6, Recnoco borrowed 15 million to finance the production of two assets, both of which were expected to take a year to build. Production started during 20X8. The loan facility was drawn down on 1st January 20X8 and was utilized as follows. Remaining funds invested temporarily. We have this, okay? We are asked to calculate the borrowing costs that may be considered that may be capitalized for each of the assets and consequently the cost of each of the assets. So we'll have Repnoco. So what do we have? I will just make it assets X and Y. X, Y. Borrowing costs. To calculate the borrowing cost,
That's the network or my network.
I think it is network. Oh.
It is network. Oh.
You are not
Hello, everyone.
Welcome back, sir.
Welcome back, Ikini. I say call me if you cannot hear me. You did not call me. You say welcome back.
Welcome back, sir.
Oh yeah, I need you.
We thought you went.
You thought I went where? Give me
You went to
figures,
eat.
Jare.
We
I
thought you
went
went
to
to
eat.
drink water.
Oh yeah. If I wanted to do that, I will not tell you I'm going somewhere.
You start from beginning, no. We did not follow your ritual.
God forbid.
You start from the question. You start from the reading of the question, please.
God
You start
forbid.
from beginning, please.
Shebi, when I started the class, I stated the conditions, Abi. I was like, hey, anything can happen, or I will not know. Once you notice you can't hear me, check. If I'm still in the meeting, just drop a WhatsApp message for me. But once you see I'm not in the meeting, just call me directly. Nobody called me. I've now finished everything. You say start from the beginning.
Sorry, sir. Start from the question, sir.
Mumbo,
Thank you, sir.
they play.
I
Oh
can
yeah,
see you're
yeah.
eating something.
Read
You're
the
eating food.
question yourself. It is food. Will you take? Get your hand. There you go. Oh yeah.
On 1st January 2026, Recno borrowed $15 million to finance the production of two assets, both of which were expected to take a year to build. Production started during 20x8. The loan facility was drawn down on 1st January 20x8 and was utilized as follows, with the remaining funds invested temporarily. The loan rate was 10% and Recno can invest surplus fund at 8%. Required: ignoring compound interest, calculate the borrowing cost which may be capitalized for each of the assets and consequently the cost of each asset as at 31st December 2026.
So that is just like the first one we did, just that this one is two assets now. So to calculate the borrowing cost, since the whole 15 million was utilized for this project, it is a specific borrowing. And we say when it is specific borrowing, the interest rate in the agreement is what we use to calculate borrowing cost. And that is the 10% in this case. So I just calculated 10% of the 5 million. You know, the total cost for assets X now, 2.5 plus 2.5 is 5 million. And we'll be capitalizing for the entire period because it's a specific borrowing. And since they told us it will take a year to build, that's why we're only capitalizing for 1 year. If they have told us it will take 9 months to build, we would have prorated it by 9/12. So that's what we have there. That's what we have there. Now, the same thing for asset Y. I'm now calculating the investment income. If out of the 15 million, they use 2.5 million for asset X in January, remaining 2.5 million for asset X. Is that 2.5 million they want to use by July, they can invest, Abi? If they invest that, they will only invest it between the period of January to June, because by July they need to utilize it for the asset. So that's why we did 2.5 times the 8% they said they can invest surplus fund for, multiply by 6/12. 6/12 being January to June. So what will that give us?
0.1.
That will be 100, Abi. I'm quoting the figures in thousands here, not million, so that it can be easy for us. And the other one is what? 200, right? So the
Yes.
borrowing cost to be capitalized will be 800 and 400. So cost of assets will be what? Construction cost, 1st January, 2.5 million, 5 million. 1st July, 2.5 million, 5 million. Then borrowing cost, 400,
You are recording this.
800. So this will be 10 million 800. This will be 5 million 400. Do we understand? Do we understand?
Yes, sir.
Yes, sir.
Yes.
Okay. Nice. Nice. Okay. Someone should take us through question 1. We have Bolu Atife and Oye PLC prepares financial statement to 30th June each year. As the following general borrowings are standing throughout the year to 30th June 2014. 7.5% bank loan, 9% bank loan, and 8.5% loan stock. On 1 October 2013, the company began the construction of a qualifying asset and incurred expenditure of 300,000. A further 240,000 was spent on 1st February 2014. Both of these amounts were financed out of general borrowings. Construction of the asset was still underway at 30th June 2014. Calculate the amount of borrowing costs that should be capitalized as part of the cost of the qualifying asset as at the year to 30th June 2014. So in this case, they haven't complete the construction, but they want us to calculate the borrowing costs that will be capitalized up to the end of the reporting date. Now, what type of loan is this? What type of loan is this?
General.
General.
General borrowing. And when you have general borrowing, the first thing that should come to your mind is that what? You need to calculate what we call weighted average capitalization rate. And what do we say weighted average capitalization rate is? It is total interest divided by total borrowing multiplied by 100. So to calculate the total interest here, we will have 7.5% of 800,000 plus 9% of 500,000 plus 8.5% of 1,000, 1.2 million, everything divided by 800 plus 500 plus 1,200 times 100. Figure. Daddy Joshua. What's the
Right, sir. Right, sir.
Joshua?
Good evening, sir.
Joshua, is that you?
Yes, sir.
Okay, I'm actually asking of your dad. How are you doing now? What of your dad? You know that guy
Fine,
that
sir.
always call, I mean that guy
Fine.
that always call your name when anything goes wrong in class. Oh,
Bolu.
I don't know if his name is Bolu. I shall know there's this guy that always call your name when anything goes wrong in class.
Yes, sir.
So what do we have? Are we following? Please, you guys should calculate figure for me. Don't tell me you are sleeping already. Oh. Figure.
8.28%.
So I have my weighted average capitalization rate to be 8.28 8.28%. Now, what that means is that you can see all of this borrowing is a total of 2.5 million. But out of it, they only took 300,000 for use on 1st October 2013. So we can't take the interest of 2.5 million and say that would be the interest borrowing cost to be capitalized. And at the same time, we can't say this 300,000 was taken out of this first one, or taken out of this second one, or taken out of this third one. That's why we have to do a weighted average capitalization rate. So we'll now say calculation of borrowing costs to be capitalized. We'll have what? 1 October 2013. 300,000 multiplied by the weighted average capitalization rate, 8.28%, multiplied by, if it was general borrowing, we'll just capitalize from this date to the end of the basic, till the end of the reporting date. But in the case of
Specific.
if it was specific borrowing, sorry, we'll take from the day they started construction of the asset to either the end of the reporting date or to the day the asset was completed. But in the case of general borrowing, it is restricted. Look at it. In this case now, I will say October 2013 to June 2014 is how many months? 9 months. Abi? 9 over 12. Is that not it? Then for 1st February 2014, I will have another, they said they took another money. They used part of the general borrowing again. How much? 240 million. They spent that on 1st April 2014. So for the 240 million, it will now be times 8.28% multiplied by what? February to June is how many months? 5 months. 5 over 12. Figure.
The first one is 18,630.
The first one is what? 18,630. The second one,
18,630. 8,280.
8,280.
Yes.
8,280. So that will give us a total of how much? 26,910. So
26,910.
26,910 is the borrowing cost to be capitalized. Now, one thing you'll notice here, if you notice the difference, is that because it is general borrowing, for me to calculate the borrowing cost, I splitted the construction cost to when did they actually incur it. But when I was calculating for specific here, I did not split the borrowing cost. Even the one that was used on 1st Jan, that was utilized on 1st January, and the one that was utilized on 1st July, I just calculated everything for the entire year. That's a distinction between general borrowing and specific borrowing. When it is general, we don't, when it is specific, sorry, we don't bother ourselves with when precisely was it utilized for the asset. So far construction has commenced, we can start capitalizing when it is general, when it is specific. So far construction has commenced, we capitalize. But when it is general, it must be for when it is actually used for the asset. That is because that fund may not even be used for the asset. But in the case of specific, they don't have another thing else to use it for. It is only the asset they want to use it for. Is it clear? Is it clear?
Yes, sir.
Okay. Let's move on to the next thing. Okay, let's look at question 4. We have HGF Co. had the following loan in place at the beginning and end of 20x8. We have 10% bank loan repayable, 9.5% bank loan repayable, and 8.5% debenture repayable. They told us the 8.9 debenture was issued to fund the construction of a qualifying asset, a piece of mining equipment, construction of which began on 1st July 20x8. What type of borrowing is that? What type of borrowing is that?
Specific.
Specific borrowing. God
Specific.
bless you.
Specific.
God bless you. Then they now said what? They said on 1 January 20x8, HGF Co. began the construction of a qualifying asset, a piece of machinery for hydroelectric plant. Using existing borrowings, they said expenditure drawn down for the construction were 30 million on 1st January 20x8, 20 million on 1st October 20x8. Calculate the borrowing cost to be capitalized on the machine for the machine hydroelectric plant. So what do we have? The one they are asking us to calculate borrowing cost for is actually the one of the general borrowing, right? Are we following?
Yes, sir.
Okay. So let's move. We have question 4. HGF Co. Sorry, is Ruth in this class? Calculation of borrowing costs for hydroelectric plants machine. Okay, what do we have? Because it is a general borrowing, we first need to calculate weighted average capitalization rate. So what do we have there?
Excuse me, pardon me. Please, are we to consider 8.9 debenture since it's a specific loan, or we
No.
are to ignore it when we are calculating the weighted average with
We'll ignore it because that one is a specific borrowing.
okay. So we are handling only two type of borrowing.
Yes.
Then. All right, thank you.
So that means it will be 10% of 120 plus 9.5% of 80 divided by 120 plus 80 multiplied by 100. Why? Because the specific borrowing of 8.9% down is only for the mining equipment. We cannot utilize it to do the hydroelectric plant. That's why we'll not be including it. So what does this give us?
10%.
Huh? Figure. So this will give us 9.8%, right?
9.8%.
So we'll now say for the expenditure of 1st January 20x8, it will be what? 30 million multiplied by 9.8%. Since it was incurred in January to December, because they told us they are constructing and they did not tell us they finished construction. That means the construction is still on till December. So multiply by 12 over 12, or you just ignore it. You don't need to put it. Then the one of 1st October 20x8 will be what? 20 million multiplied by what? 9.8% multiplied by what? October to December will be 3 over 12. What do we have? What do we have?
That one is 2.94.
The first one?
Yes.
Uh-huh.
0.49.
0.49. 0.49. So that will give us what in total? 3.43 million.
3.43.
That's the borrowing cost to be capitalized. That's the borrowing cost to be capitalized. 3.43 is the borrowing cost to be capitalized. But if we are now to calculate the borrowing cost to be capitalized on the mining equipment, this one is not part of the requirement. So it should have just been what? 8.9%, because that one is a specific borrowing. Abi, multiply by what? They said they did not tell us how much they have even incurred on the asset. They did not tell us how much they have incurred on the asset. But because it is a specific borrowing, we'll just say multiply by the what? 150, because we know the entire money will still be used for the asset. 150 multiply by what? July to December would have been 6 over 12. And that will give us what?
6.675.
6 points.
Yes.
6
675.
points what? 675.
675.
Yes, sir. 6.675 million. So that is that. Kogba thinking. Let's look at question 5.
Pardon me, before you proceed, may I ask a question? This your notes that you're using to actually analyze all this. Can you
Yes, sir.
actually, at the end of the class, can you paste it for us so that we can actually review it? Because I'm not picking some side
I should
things
paste it
faster
for
than.
you.
Yes, paste it on the group, like these notes on the group, not necessarily the recording, the note itself. This your board. Can you help us with that, please?
I will think about that.
You're not a woman now. I'm not toasting you. Thank you.
Okay.
Sorry,
If
sir.
you think you are not toasting me, no problem.
Hello.
Huh?
So is based on the mining equipment, that specific one, is it part of, it's not part of the question now?
Yes, it's not part of it.
Okay.
We just did that. I just used it to explain. Hey, that person, my mic is, the network there is not that good though. Chai, I can't hear you.
The lecture tonight on recording, so that I can able to paste it for us on PDF.
PDF, okay. Paste PDF for recording. Don't worry, don't worry. Both the lecture notes, I'll send the lecture notes. For the recording for today is on record, but I don't know what will happen the next time. So let's quickly go. Let's quickly move. I don't want us to exceed a specific time on this call. SPAR Limited, a jet company, has the following loan arrangements as at 1 January 2015. We have all of this. On 1 April 2015, the company commenced the construction of a new office building. The construction of the factory will cost them 150 million, and the company expects to fund the construction from its existing borrowing. The factory was completed on 31 December 2015, but was not available for use until 1 March 2016 as a result of minor modification. During the construction period, active work was interrupted and the building construction was stopped for 1 month as a result of adverse weather conditions. So if we are to calculate this, what do? We'll just have, first thing first, question 5. Weighted average capitalization rate will be what? 15% of 25,000 plus 6% of 60,000 plus 15% of 120,000 plus 20% of 150,000 divided by 25,000 multiplied by R plus 60,000 plus 120,000 plus 150,000. Everything multiplied by 100. That will give us what percentage? Fast finger. Wait, what of that guy that used to sit at the back? The guy at the back, you know yourself. Oh. Is Taiwo in this class? Oh, well done. Good evening. You are still using bedroom voice, even in this class. That's what you used to catch Mrs. Obert. Keep it up.
You got bedroom voice. You understand. This 75 question right now. I'm still trying to
Huh?
sorry.
I can't
I'm
hear
still
you.
trying to find myself. So I think I don't have choice than to watch this over and over and over again. I'm still trying to find myself.
Hey, don't worry. You will find yourself. Do you know this? Do you know this hymn? Amazing grace, how sweet the sound. Do you know it? Okay. The weighted average capitalization rate is 15.59%. So to calculate the borrowing cost now, the borrowing cost will now be what? 15.59% of how much did they say it cost them to construct the building? 150 million. So multiply by what? Since they did not give us breakdown of how they took the money for the building, we are assuming they took it all at once from that 1st of April that they commenced the construction. So 1st of April was when they commenced the construction, but they told us that it was completed 31 December, but it will not be available for use until March 2016. When do you think we'll stop capitalization of borrowing costs? When do we stop capitalizing borrowing costs?
The 1st of December.
Is it not
31st
December?
of December, because the asset is already done by that time. So either they now put it to use or not, is there what is remaining for it is minor modification. So we have to stop capitalization as at 31st December. So that will just be 9 months, 9/12. And that will give us how much? And now for the interruption, the work was stopped for 1 month, but it was as a result of adverse weather condition. The company does not have control over the weather. That's why we will not suspend capitalization of borrowing costs for that 1 month. If it was as a result of faulty design or as a result of wrong supply of products now, then that 1 month borrowing cost will not be capitalized. I would have made this 8/12. But because it's an adverse weather condition, which is outside of their control, that's why we are still capitalizing for that 1 month. Is it clear?
Sorry, sir.
Is it clear?
For the minor, for the what's it called, for that 1 month that you are saying, sir, is it going to be that 15.59%? Is it all over? Will it be 8/12, sir, or what?
Yes, it will be 8/12.
That's
If that 1 month was as a result of their personal distance.
okay. We'll be removing the 1 month from the 9, abi?
You remove it because they were the one that deliberately did not work for that period. It wasn't as if the stoppage was as a result of factors outside of their control. But if the stoppage was as a result of factors outside of their control, then we'll just capitalize for that period also. Is it clear?
Yes, sir.
Okay. So figure, what do I have?
17.54.
$17.54 million. Sorry. That means the total asset cost will be what? 150 million plus 17.54 million. And that will give us 167.54 million. Does it make sense to us? Does it make sense?
Yes, sir.
Okay, nice. So let's wrap it up with one question and we go to sleep. So, assignment before we call it a time on today's episode of our class, as we have done this today now, before our next class, which is on Sunday, each and every one should go to the past question and do and attempt at least 2 questions on borrowing cost. At least 2 questions on borrowing cost. Whatever you attempt, we'll deal with it in our next class. We'll have discussion on it before proceeding to the next standard. Is that clear?
Excuse me, pardon me. There's a question, there's an assignment regarding to group accounts. Yeah, I tried working on it and I was expecting to ask question on a Sunday class. Is that going to be considered as well?
You ask your question in Sunday class.
For the group account, if I may ask.
No problem. You can ask your question in the Sunday class, but it would have been better if you ask now so that you can fix whatever is wrong there. before that Sunday.
Thank you.
We have Dudu Yemi PLC. Gear company has the following loan arrangement as of 1st January 2015. 1, 2, 3, 4, 5. On 1 January 2015, the company commenced the construction of a new office factory, which is expected to take a year to build. It is expected to take a what? A year to build. The company expects to fund the construction from its existing borrowing, that is, from the pool of funds. The following expenditure were made during the year. Bas. They said the company's investment manager has suggested that temporarily available surplus fund, if any, can be invested at 5% payable monthly in arrears. The company's bank overdraft as at 31 December 2015 amounted to 260 million, with a weighted average of 200 million for the year. The interest charges on the bank overdraft amounted to 17.4 million, and none of the existing loans have been redeemed as at 31 December 2015. Calculate the borrowing cost to be capitalized. Calculate the cost of the assets for inclusion in the statement of financial position upon initial recognition as at 31 December 2015. Now, just like we have been doing, question 6, Dudu Yemi. Because it is a general borrowing, the first thing we should do is what? Compute our weighted average capitalization rate. And our weighted average capitalization rate will be what? We will have 10% of 175,000 plus 15% of 280,000 plus 12% of 80,000 plus 6% of 60,000 plus what? The interest on the bank overdraft will come to the note. They told us the interest for the bank overdraft was what? 17,400,000. So that will be 17,400. Everything divided by 175,000 plus 280,000 plus 80,000 plus 60,000 plus for the bank overdraft. We will not use this figure they have at the beginning of the year. Rather, we'll use the weighted average for the year. But coincidentally, the weighted average for the year is the same thing as the figure they have at the beginning of the year. But I'm not using this one. Let me color it red so you can understand that I'm not using it. This one, I'm not using it. I'm using the weighted average. So the weighted average is 200. So we'll say plus 200,000. Everything multiplied by 100. Figure. Are we sleeping?
As 11.3%.
11.3. Is it not 2 DP?
Yeah. Yes, 3333.
So let's use 11.33%. We've been using 2 DP since. So if that is the weighted average capitalization rate, then we can now proceed to calculation of borrowing cost of the asset. Borrowing cost will now be what? 1st January. We have what? 11.33% multiplied by 30,000 multiply by what? This will be 12 over 12, abi? Because it's for complete 12 months. 1 April, it will be what? 11.33% multiplied by 25,000 multiplied by 9 over 12. Multiplied by 9 over 12. Then 30th June, 11.33% multiplied by 20,000 will be multiplied by 6 over 12, because June will not be inclusive since it's 20th June. Then we'll have okay, to my soldiers that are fighting for me on the group, I see you, I recognize you. Well done. 30th September, 11.33% multiplied by 15,000 multiplied by 3 over 12, because September will also not be counted. September will also not be counted. So what do we have in total? Figures. Kenji, figures.
I cannot see your screen again. My network is bad.
Ìkúnlẹ̀ abiyamọ o. Sorry. Sorry.
Me too.
Please, can others see my screen? Can anyone see my screen? Hello?
You can see it now.
Okay.
I can see your screen now.
Okay. Ẹ pẹ̀lẹ́. Ẹ pẹ̀lẹ́. Ẹ pẹ̀lẹ́. So that's giving us 7,081,000. So asset cost. Asset cost will now be what? Asset cost will be construction cost. First January, 1st April, 30th June, and 30th September. 30,000, 25,000, 20,000, 15,000. Then borrowing costs. 7,081. And that will give us how much?
97,081.
97,081. So who can tell me what is there anything we did not use in this? Is there any information we did not use in this question, or something that might seem strange to us, or something that we feel we should have done we did not do? So you will notice that I did not use the
What about the 5%?
investment in. Yes, we did not use it because this is a general borrowing. Except they now tell us themselves that okay, oh, the remainder of the borrowings will be invested. We don't know how much was actually invested for them to get that 5%. And even if they tell us the amount that was invested, that income cannot be used to reduce the borrowing cost for a general borrowing. So now, when we were calculating weighted average capitalization rate, what was the total borrowing cost, the total interest to calculate? I mean that numerator. What was the figure?
795,000.
795.
Yeah.
That's a bit strange.
Abi,
Are you sure it's
wait to
795?
I'm calling. I'm calling
Ayamija.
me.
Well,
And
it
now
should
it's
be
795.
90,000.
Wait, what are
Not
we
the
saying we should
total
calculate?
of the numerator.
So, and now, so is it not the
So now,
175 plus 3?
no. This one up one, up.
Okay, so sorry.
So if you look at it, the total interest for the period would have actually given us 90,100,000. That was what we did divided by the 795,000 times 100. But what am I driving at is that out of this 90,100,000, only 7 million is what we are capitalizing. That doesn't mean they will not pay the remaining interest. But the double entry for it would now have been debit, credit. We'll debit our asset costs with 7081. We'll debit SOPL with the remainder, which is 90,100 minus 7.081. And that would have given us, we'll debit SOPL with 83,019. If we have paid, we'll credit bank with the whole 90,100,000. But if we are yet to pay, we take it to our accrued income, accrued interest. Do we understand? Do we understand? Hello?
Something like that.
Yes. So what I'm just trying to tell us is that the fact that we said that we are capitalizing only the portion that was used for the qualifying asset does not mean they are not incurring the remainder of the interest cost, but it will be taken as what? As an expense. It will be taken as an expense for the period in which it was incurred. It will be taken as an expense for the period in which it was incurred. So that is that. Do we understand? Ladies and gentlemen, in the absence of question, I would like to call it a time at this point tonight till we meet again.
Thank you.
Thank you. I
Hello?
appreciate it.
Thank you, sir.
Till we
Thank you, sir.
meet,
Thank
till
you.
we meet,
Please,
till
oh,
we
anybody
meet.
that wrote, please snap your note and send on that group, oh, please.
What snap your note and send on that? You will not stop the store. Baba, at this your old age, you are saying